You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music means we are back once again for Education Wednesday, a very special double edition of Education Wednesday. It's double pro week across the entire network yesterday. We did double pro Q&As yesterday. We're doing double options boot camps today. And of course, not to be left behind, also a double dose of OPR, one of them going out to you folks on demand right now as we speak, live to tape. Then, of course, for all you Secret Club kids, you get to hear this one a week early because, yes, we are going live once again with a very rare Huddle episode of Options Playbook. So it's very exciting. And joining me to help answer all your questions, because, hey, it's his show at the end of the day. It wouldn't be fun if it was just me. He is none other than the options guy himself, Mr. Brian Overby from Ally Invest, a.k.a. the author of the titular Options Playbook. Mr. Overby, welcome back to your own show, sir.
All right, Mark. Yes, it's great to be back, and I love that we are going live. So very rarely do Mark and I get a chance to huddle up, but today we are going to take that opportunity as the Fed is speaking right now to speak live to all of the OPR listeners. So thanks for coming, everyone. And Mark, let's huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody. Welcome to the Huddle, the portion of the show where you folks take the reins. We are guided by your questions, your comments, your insights, all sorts of fun stuff. You guys know how to get at us by now. You can get at Brian directly at Brian Overby on Twitter. Of course, you can find us at Options on most of your major social media platforms. Questions at theoptionsinsider.com also works. And of course, for all of you cool kids in the Secret Club, if you join us live, you can get your questions bumped to the top of the list there as well. So, Mr. Brian, are you ready to do this, to embark upon this journey, sir?
Yes, I am. Let's do it. Let's light this candle.
All right, let's do it. Actually, let's start off with some fun. We had a listener send us a screenshot of, I believe this is the Safe Haven thread on Reddit, in which they list what they term quality and key information sources for options traders. And guess what one of those top links is, Brian? What are they sending people to?
Nathan Sheldonberg's book.
Shelly Natenberg. Yeah, ironically, I don't see him on there, which maybe makes me question all of this. But no, it is right there. I think you're number 4 there on the list, or number 5. It is the options playbook, which they call Introduction to Options.
That's awesome.
So there you go, sir. All these people are always talking about Reddit left and right and how they're driving a lot of flow these days. Apparently, they're also driving a lot of people to the playbook, sir. So well done there as a trusted source of options, at least when it comes to Reddit, sir.
Yeah, that's fun. Yeah, I did a little Reddit thing back in the day where, they had an expert option trader on and people were able to ask questions. There sure are a lot of bots that are in there, but we did have a little bit of fun with it.
Bots on Reddit? I refuse to believe it, sir.
Yeah.
It's insane.
That is true, though. Awesome. Awesome to get to see the name in print on Reddit in a nice format, nice little list. And I just think it's great. It was really fun of whoever shared that with us to let us know about it.
All right, speaking of letting us know, Brian, I wanted to get your thoughts on this before we dive even more into the listener questions. We have a question of the week this week. We always ask our audience various poll questions. And the second we posted this one, I said, you know what? I need to ask Brian this one because in the past, you've been one of the more, shall we say, outspoken opponents of some of these inverse volatility products. And XIV, of course, very famously imploded a few years back. And people have been waiting and debating ever since. Should these things return? Well, now we have recently, just last week, the relaunch of SVIX, which is trying to take that XIV, aka the inverse volatility mantle, and run with it a bit. And right now, we have a question of the week along these lines, Brian. We're asking our audience, we said, the launch of SVIX last week has rekindled the debate over whether these products should even exist. So we put the question to you, should inverse volatility products exist? Yes, they serve a purpose, or no, they are too dangerous. And right now, seems our audience is very clearly in the yes camp, about 80% versus 20% saying, no, they are too dangerous. But I know, Brian, this is an interesting subject for you. I think I know where you're going to vote. But first off, what is your vote if you had one? And then B, what are your thoughts on the return of SVIX and inverse vol, sir?
Mm-hmm. Well, I think they're too dangerous and too expensive. We talked about gold last week, a couple weeks now, depending on when you're listening to the show. But GLD, there are a few ETFs or ETNs, exchange traded notes, which this is, I think, would be the SVIX would be considered a note. But it just means when they're usually notes, there's a little bit of different rules. They usually have higher fees to actually run that fund, and it just has turned out so many times that they don't really relate to what's going on in the VIX index or whatever it's trading around. So a lot of fees in order to run these type of products. And then on top of it, you always are surprised by how the SVIX actually reacts to a down day in the VIX. So to me, it's just, you're just totally guessing if you're investing in those things. I've never invested in them on a long haul. You might try to take some speculative bets during the day, but I prefer to lay down until the urge goes away, just in general. So surprised to see the numbers so high about them serving a purpose. Actually, Bloomberg has a real neat little thing that kind of gives a rating scale to ETFs and ETNs. Not surprisingly, gold is very highly rated within that Bloomberg, I guess, table, for lack of a better term. And things like the SVIX and all the other ones that are out there are usually score extremely low.
Yeah, it is pretty firmly in the yes camp. We do have some hardcore listeners in our audience, Brian, so that probably does account for it, though. By the way, you mentioned your catchphrase there of lay down until the urge goes away. You'll be happy to know that seems to be propagating throughout our network. I heard Andrew, the Rock Lobster, he's used that a couple of times to me recently. He's like, what's that thing Brian says? Oh, yeah, I want to do the urge lie down. So your catchphrase is starting to propagate, Brian. So there you go. Your book's on Reddit. Your catchphrase is catching on. You're becoming a hit out there, Brian.
Well, don't forget the fig leaf. We got to toss that in there.
That's true.
Always got to talk about fig leaves.
You have coined the fig leaf as well. Let's get out some of you folks here. Let's see. We've got Bits. He says, when Brian does a skip strike fly, when does he roll? Does he only roll the losing part of the butterfly or the whole butterfly? Also, I know he likes to look at straddles for his entry points, but does he use anything else like technical analysis, etc.? So it seems like a bit of a three-parter. He wants to know when you roll your skip strikes. If you do roll, do you only roll the losing part or the whole thing? And then do you use anything else besides the straddle to gauge your entry points, Brian? A three-parter from Bits. He's very, very involved.
Excellent and great questions, without a doubt. So I very rarely will roll it because, first of all, with skip strikes, sometimes I start with a long call spread and then I roll into a skip strike. So that's kind of my move, either a long call spread or a long put spread, and then roll into the butterfly. Now, if I'm starting out just as a skip strike, I just really watch where the underlying stock is at. Always trying to do them very short term. If by chance, let's say we did a week-long skip strike butterfly. And if we're doing it, we're probably doing it on an expensive stock, and we put it together on Monday. If by Tuesday it skyrockets up and gets close to my short strike, I just close it. I don't mess around with it. Obviously, at expiration, that's going to be a great trade. But to start with, if it comes running all the way up, it's already definitely moved more than expected. Bits is mentioning the straddle. So if that has happened, the sold option contract is usually up higher on the call side than the straddle is, because that's just the way that we set them up, or lower on the put side if we're bearish. And because of that, that means it's already made a very strong technical move or momentum move, for probably using a better term, and I just get out. I feel like with butterflies, it's already a three-legged trade, and I don't want to overtrade. I find I've had a lot of people actually give me calls and basically say, I'm really hurting on this trade. What should I do? And I said, well, I don't know. If you drove your car off the cliff, would you take it to a mechanic and say, fix it, right? Because if there's just sometimes you just can't do anything with the trade. It's just too late. It's too far. You're grasping for straws. So when I start with a butterfly, I'm very rarely going to adjust it, because to me, I manage the risk by putting the butterfly together. So now I'm going to set an alert and I'm going to watch where it is as far as the price is concerned. Last question, I don't want to forget about it, Bits, is do you use any technicals? I really like trend lines. I like support, resistance. Always, especially in indexes, pay attention to moving averages, 20-day, 50-day, 200-day. Those are I think, influence me the most as far as my trading is concerned. And I also want to keep it simple. I don't want to overthink it. I'm trying to come up with we actually just taped a show regarding the Fed and everything that's going on in the marketplace. And the market is just very bearish today. And the Fed might be speaking at this point in time, but we just wanted to look at the trade, say, let's use options to try to speculate and be contrarian as to what's happening in the marketplace. So that had nothing to do with the chart. That had everything to do with how the market was reacting. And from time to time, I'm going to look at those type of trades depending on where I'm at in my world and how busy I am. I do have an actual job for Ally Invest, and sometimes they don't like me trading all day long. But with that said, the technical analysis thing, especially, we talked about a straddle a couple of times. We looked at a long straddle in Micron Technology not that long ago. And that was right because it was at a precipice of a new all-time high. And that was 100% because of breaking out to a new high or failing, which it did fail, and it failed hard. So the trade actually worked out. But there you have it. So I don't know if I really firmed that up. I gave you a lot of thoughts on it, but the answer is it depends when I'm looking at especially speculative trades. If I'm going to use technicals, if I'm just basing it off of the news. I don't like to adjust butterflies. I like to adjust long call spreads and put spreads.
I'm telling you, Brian, I'm going to start compiling the book of Brian's folksy wisdom. You got laid on until the urge goes away. And what's the one you just did? Your car goes off a cliff. You don't bring it to the mechanic.
And you got to, because you just, but it's an interesting scenario because it's trading. It's not even close, and there's no time premium left.
No, it's perfect. I love it. It's very apt, and it's also a lot of people do reach out to us at that moment, right, when the trade is irrevocably gone. and yet they want some magic fix that will make it come back to make the car go back up the cliff, to use your analogy there out there. So yeah, that's a good one.
Back in a time machine.
How long do people start borrowing that one on our network? I wonder. Let's see. Speaking of which, just like the live folks are having fun. Nichols is excited. He says, yo, Brian's live. He's excited about that. We've got Option God. He's one of our newer listeners. I recognize him. He says he's excited to hear you live, Brian. He's never heard you live before, so he's very excited. We even got Luigi in there heaping praises on our producer, Jean. I guess he was having technical problems, and she helped him out. So there you go, Brian. People are having fun, enjoying the live OPR. I guess that means we have to do it more. I think they just want more of your folksy wisdom, Brian. That's what they want.
Good, clean fun.
Good, clean fun. All right, let's keep the good, clean fun and folksy wisdom rolling. Let's go out to, looks like Philosopher here. Philosopher says, how long do you have to exercise options after the expiration date? Also, how does that work with margin? So if you have a covered call where you bought the shares on margin and then were assigned, so a twofer. Brian, you're our duly appointed broker representative, so you have the latest up-to-date information on all this fun stuff. He wants to know, how long do you have to exercise after expiration? And then when you have shares on margin, how does that impact things?
All right. So first answer is not long and depends. So it depends on the broker that you're with. A lot of brokers will give you about a half hour. So if the market closes at 4 o'clock Eastern time, you usually, if you're looking to exercise, you would have to give them a call within the next half hour of that expiration. But there's a big asterisk next to that. If the option contract is 1 cent in the money and you do have the cash in your account, the broker will probably exercise on your behalf. So where we've had more issues is that the option, let's say, was a dime or 15 cents out of the money on a call option, let's say, and it rallies into the close and finishes 1 cent in the money, and the investor just assumes that it's going to expire worthless, and they wake up on Monday morning and they got 100 shares of stock. And so that's one of the bigger issues, but you should know that the broker wants to hear from you. If you are not planning on exercising an option contract, that's when we get more calls and that, oh, it's 1 cent in the money. I don't want to exercise. Please cancel that auto exercise of my position. And I think that's the one where, 1 cent, why do I care? I don't want to have the risk over the weekend of owning 100 shares of this underlying stock. So you have about a half hour after the close, because brokers will put different cutoff times. I'm not exactly sure when we have to get our information into the Options Clearing Corporation, but we have to get that information and then we have to transfer that information. So I would say in general, most brokerage firms are about 30 minutes. You know where the stock is at. So go ahead and decide or not decide to exercise your option contract. Now, there could be an exception to that rule, maybe, and stock and companies purposely don't do this because let's say the company announced earnings on Friday after the close. Like, obviously, that would be a very, very hard move for market makers, a very rough move for companies to do that. But you don't ever really hear that. But sometimes major news can come out. So moral to the story, you have about a half hour, but you want to check with each and every broker to make sure.
Just to clarify, you talked about the contra exercise orders. You guys at Ally, I'm sure, still require you to manually contact you for the contra exercise. There's no button on the Ally website, right, that says do not exercise, right?
Yeah, so I kind of belabored my point. My point is that, to me, is a more important scenario. If I am going to exercise as 1 cent in the money, they will do it on your behalf. So there's really nothing to call about. It's about the contra exercise. And then I see part two of the question. If you did a covered call and you're going to be assigned, well, there's no problem with that. Go ahead and allow the stock to be called away. If you're trading on margin, it's going to be the exact same thing as if you sold the stock and you were on margin. You're going to get that margin release. The cash is going to come back into your account, and you're going to get that benefit. Bottom line is you're going to get that on Monday morning, as opposed to getting that benefit of that cash coming into your account on Friday, right? Because you got to wait for that assignment to happen, and that's going to happen overnight. A lot of times in this day and age, you used to have to wait till Monday morning, but now you usually see that cash coming back into your account on Saturday when you get up. Overnight is usually when it happens.
All right, Brian, I mentioned your broker perspective. Luigi in the live chat wants to mine that brokerage perspective a little bit. He says, from a broker perspective, Brian, what makes a brokerage firm shy away from offering crypto? So he wants to know what were some of the impediments at Ally for offering crypto, sir?
First of all, it's a lot of work to get to the point where you can offer the crypto, right? It's a lot of back end, a lot of trading. You're not using your normal systems to do it. Then on top of it, you obviously have a lot of risk. You have a lot of risk and you have to manage that risk. So you need to have a team of risk managers just to make sure that people aren't trading the crypto too heavily and that you're managing your risk in that way. And, so you got to weigh all of that tech pull, the risk that you have to manage, and you have to have like a special team to manage just the crypto risk, and then decide, well, are the commissions from doing this worth it? And what about the regulation? Where is the regulation going to come in, and how might that affect it? Because we really are, even though crypto's been around for a while, the regulation and what's going to happen with crypto hasn't really been established yet. So there's a lot of reasons to shy away from it. Actually, more reasons to shy away from it than to jump in. But in the future, when some of this stuff kind of plays out, I expect a lot more brokerage firms to join in that offering. But the short term, I don't see it.
Yeah, it seems like a few firms now are offering the CME futures for obvious reasons, because they have clearing and there's no counterparty risk like there is in a lot of the other crypto products out there. And they usually have futures platforms already, so it's easy just to add a new product there. Obviously, BITO, I think we'll have a question about BITO, so we'll get into that maybe a little bit later. So BITO is another way a lot of these platforms are starting to dip their toes into crypto without all of the counterparty and other risks that you see inherent in the crypto space right now. But a good question, Luigi. I think we will see more adoption. I mean, it is such a fast growing asset class, right? That you can only ignore it at your peril for so long. All right, let's keep on rolling here. Let's go to Unto Caesar. We got good handles on the show today, Brian. He says, hello. This question may be basic, and you've probably covered it already, but I'm a new listener. First off, if you're a new listener, I recommend heartily, if you haven't done so, listeners, you have 400 plus episodes of great options playbook goodness to sink your teeth into. I know it can be a little bit intimidating. It's a deep archive, but if you start there from the beginning and work your way through, by the time you get here on your commute, whatever you're doing there, they're pretty bite-sized, 15, 20 minutes for a lot of them. You can do quite a few on a decent commute. Then you'll have a pretty decent to strong understanding of what the heck's going on by the time you catch up to these episodes. I'm just saying, Unto Caesar, it's a good practice to go back and check out the archives. But he wants to know, I'm a fan of credit spreads, but I'm having a hard time determining where to place my stop loss. Any tips would be appreciated. So, Brian, he's selling credit spreads, but he doesn't know how to stop himself out, sir.
All right. Well, and you would want to know, are you selling, this is an advanced topic, but are you selling something that's like a 20 delta option contract where you have a 20% chance of the option finishing 1 cent in the money or out of right relative? So it has a little bit to do with your risk and your reward, but a simple way, without knowing anything about your trading or what you're looking at, is if I sell, let's say, a 5-point wide spread and I bring in $1. I think that's a common trade to do. So I am out of the money. I could be on the call side. I could be on the put side. If I'm down that $1, I'll get out of that trade. So you just want to be consistent about it, because the maximum you could make is $1. If it goes against me, I don't want to lose more than the maximum I could have made on that trade. Now, with that said, if you're trading a very volatile stock, that doesn't give you a lot of play. Okay, so I'm okay with saying on a 5-point wide spread, I'm bringing in $1. I have a high probability of making that dollar, the math says. So I'll let it run a little bit and I'll close out my position if I'm down $2 on that trade. In other words, I could have made $1. That's the maximum I could have made. Now I'll give myself a little bit of room. And if I'm down $2 on that trade, then I'm going to close it. Okay. So that is two ways to approach it. To me, I want to be more consistent. It's going to depend on the underlying that I'm trading. If I'm doing it in indexes, I might be a little bit tighter than opposed to on specific stocks, just because on indexes they're a little bit less volatile than usually individual names. And so I'm going to try to be consistent with it in the way that I approach it. And the biggest thing to me is that you want to have a plan and stick to the plan when you're doing it. Even though it might not feel right to close out that trade, a lot of times some of my best trades were made when I didn't want to get out of the position. I thought things were going well, but I forced myself to because that was the plan. And lo and behold, they went harder against you. So credit spreads as a very beginning option trader are tough because because of the risk reward ratio. In some ways, I think long spreads can be easier to start with because you don't have to worry about the big move. You don't have to watch them as closely. Not saying that I want to buy time premium versus sell time premium. I'm just saying that in the scenario where, like last week when we're looking at SPYs, I can manage my risk. If I buy a long spread, I can come in and say, well, I'm going to have I have a 10-point wide trade. I'm only going to pay $3 for it. I'm going to have $3 of downside, $7 of upside. And I managed my risk right there. So I don't know. I go back and forth a little bit on it. I like to do short spreads. Obviously, the probabilities are with you a little bit more on them, but they definitely hurt when they go against you. So I guess I'll let Mark follow up on that. I hope I didn't confuse more than help.
I would just add to that whatever you're going to do unto Caesar, you should decide on it at the outset of the trade. You don't want to make this a game time decision where things are happening. Right now, the Fed's popping off. We're seeing, movements in the markets as a result. You don't want to be making these decisions then. You want to set it ahead of time so that if you're, like I said, Brian said, you sell the credit spread for $1. If it goes against you, maybe for $1 or whatever your risk tolerance is, 30%, whatever the case may be, determine that at the outset and set that stop loss ahead of time. So you don't have this little bit of subjective wiggle room that you could expose your trade to, and then maybe you don't take it off, and then it gets a lot worse. If you take it off, you take a little bit of a hit, but you live to fight another day. So definitely establish that at the outset. It's a good way to at least try to extend your options trading career a little bit. All right, speaking of options trading careers, we just talked about beginning trades. A similar question here from LBJJ. So maybe LBJ Jr., maybe LBJ's kid, great-grandson, saying, what is your favorite starter options trade? I've owned stocks for years, mostly S&P index funds and some large caps like Apple and Facebook. Where should I begin my options journey? Brian, you and I in the past have talked about this, the beginner options trade. We've given some interesting suggestions over the years, but we haven't talked about it in a while. So maybe it's a good time to revisit it, especially now with so many new people joining the business. We just heard March, the second busiest month in the history of the options business. So folks are still trading up their options. What do you have to say here for LBJ Jr. here? He wants to know where he should begin his options journey, sir.
All right. So if you're looking at an options journey, one of the biggest things is to realize that options were actually first intended to be a protective vehicle. So in other words, they came from a need to protect an asset, not for speculation. So I wrote a white paper that is actually in the LI Invest community talking about the top 10 mistakes that option traders make. It's been out there for a while, so if you Google my name and top 10 mistakes, it's going to come up, as opposed to, I obviously can't share a URL with you right now. But with that said, I like the concept of using trades that enhance a stock. So I have Apple. I wouldn't mind selling it. I own 100 shares. I look at selling a covered call against that Apple or Facebook position. Now, I want to be prepared to sell the stock if I'm doing it, especially on a beginning basis. I would look to do that. Now, on the other side of the coin, I really don't like the biggest mistake I see is people buying out of the money calls, buying out of the money puts to just speculate on price and not understanding how options are priced just in general. So because of that, I shy away from those purely speculative trades. And we recently, looked at buying deeper in the money option contracts. One of them that we talked about is on an energy stock. We looked at MRO. We talked about buying deeper in the money option contracts on the XLF, which is the financials. Now, these were some of the episodes going back 4, 5, 6 months in time on Options Playbook Radio. And those, to me, we build them mostly as FOMO trades, fear of missing out. That's also an interesting alternative to just buying the stocks outright. Now, when you get comfortable with option pricing, then looking at things like credit spreads, long spreads, those type of trades, I feel much more comfortable with. But you really want to see how your options react relative to the stock price, because you need to develop realistic expectations before jumping into option trading wholeheartedly. And I think when I do basic courses, I start by teaching option pricing. I don't start by teaching what a long call is or what a long put is. I don't go to the strategies right away, because I think understanding the pricing is more important in being successful in option trading than it is to truly understand all the different strategies that are available.
Yeah, I definitely agree with that. Some people bristle when I say, "Oh, covered call is your first trade." I think buying an option is more intuitive, and that might be. But I think for the case he laid out just now, he's long Apple, he's long Facebook, he's long S&P. A covered call is a no-brainer for someone like that. It's a very simple thing. They understand buying and selling stocks. Now you're telling them you can actually get paid to sell that stock at a certain level. It's kind of a no-brainer. So I definitely lean that way as well. Selling a covered call is just a great starter use case for a lot of people who are coming to options from the world of equity. Speaking of use cases, Brian, looks like let's go back to the live chat. I don't know, Brian, you're getting a lot of love in the live chat today. I don't know if you can handle it. Are you ready for this? All right.
All right.
First off, we've got Option God here. He says, I just wanted Brian to know that one of my first options trades last year was a skip strike fly on Jets. I did it after learning about skip strikes on OPR, and it worked out great in all caps with an exclamation point. Over 200% return. Thanks so much. It made me a much more confident options trader, Brian. So there you go. A little bit of love.
Interesting. And he jumped right in with a skip strike. Why not?
Why not?
Why not? Well, that's great.
And then we got Mr. Unlimited chiming in, says, I think I remember that episode. I also did the same Jets trade. I remember tweeting at Brian. It was very profitable. So there you go, Brian. Getting a lot of love for your Jets trades here on the show. What do you say?
Yeah. Well, I do remember. I remember we did the election show, which wasn't on Options Playbook Radio. And I totally remember this, Mark. We were talking about it, and I said, well, this was the definition of a FOMO trade. Maybe think about buying a deeper in the money call option on something like the Jets, just in case they come up with a vaccine. And sure as heck, on Monday they did. And I think we did that show on a Thursday or a Friday. I can't remember.
Well, there you go. The Jets won.
I remember that.
Living on in the annals.
See, that's a great way to try to manage some risk. You don't want to put too much down, so you manage your risk. You go a little bit deeper in the money. You don't want to just buy the Jets outright, because all of the airline stocks and travel stocks that are in it were extremely volatile at the time. So you had limited and known risk. But just in case, a known event that we were out there just waiting to, when they're throwing so much money at the vaccine that eventually you hope somebody's going to come up with that answer. And so, yeah, there you go. That's where we're at.
That is where we're at, indeed. Speaking of crypto, we were talking about this earlier. We got a question from Mr. Crypto. I wonder what he wants to know about. He says, I'm loving the playbook and learning about all these cool option strategies. It's really transformed my trading. Thank you so much. Well, Brian's going to get a big head after this show. He's getting all this love. He says, as my handle shows, I'm also into crypto. Somehow I missed the launch of BITO options last year, so I'm late to the party. Wow, we weren't listening to the network there, Mr. Crypto, because we were talking about BITO a lot last year. He says, he goes on to say, what does Brian think of BITO as a trading vehicle for crypto heads like me? Seems like one of the only options, pun intended, for US-based customers who want to trade Bitcoin options. Well, Brian, you and I were chatting a little bit about about BITO prior to the show. I'm curious, for you over there at Ally, have you had a lot of chance to sink your teeth into this one? Are the folks at Ally trading this one up? And what do you have to say for Mr. Crypto, who thinks that maybe it's one of the few options, pun intended, for U.S. crypto options traders?
Yes, of course it is. Yeah, that's exactly what it is. It was a big deal when they launched. It took long time to get the regulation down all around it, and it is an okay alternative if you don't want to have to go to a specific crypto broker or a specific crypto chain. And, I also look at other underlyings, and I think we've actually done a few shows on Options Playbook Radio on Coinbase, which is an exchange that mainly trades crypto. And COIN is Coinbase, is the underlying stock symbol. And it is in those, there are a few other extraneous plays that you can do around crypto that will benefit if the crypto space continues to grow. And obviously, this is one of them. One of the things about crypto, though, is everything is volatile. And you really have to be able to accept that type of volatility. But very excited that BITO came up and offered that opportunity to follow the market. But obviously, it's been rough. It's been a rough ride in BITO over the past year, and even year to date, it's down quite a bit. So it's tough to try to jump in, and there's always fees, and that's the other things about any of these ETFs and ETNs that track these really specialized trading vehicles. You always got to be a little bit concerned with the fees. And I'll pass that back to you, Mark. I mean, you guys talk about it. You talk about it more than I do, as far as the topics, because I know you get so many questions on the show.
We do talk about BITO quite a bit. We were talking about it yesterday on our Pro Q&A. We had a guest talking about leaps in BITO, which is an interesting use case in and of itself. I won't get into that in depth here. Maybe check out the Pro Q&A if you are inclined there, listeners. Just theoptionsinsider.com/secret club is the place to go to hear all that and all the good stuff. I pulled some data for you, Mr. Crypto, to give you a little bit of expectation of what you're getting into. And Brian's right. BITO has been trading it up. I mean, it launched with great fanfare last year. They got listed. It's kind of the fastest turnaround I pretty much had ever seen at that point for a new product launch to options being listed. It was within 24, maybe 48 hours. It was super fast that they added these options. So that was a sign that people were expecting a lot of action from this. And it pretty much has delivered. As of this morning, the ADV out there is 59,000 contracts. So that's nothing to sneeze at out there. There's a lot of names out there that can only do a few hundred, maybe a few thousand contracts a day. So 59,000 contracts a day. This thing is trading it up. Now, it's been interesting to watch. We track the evolution. If you like this, Mr. Crypto, I also encourage you to check out our Crypto Rundown program. We talk about the skew out there in a lot of these products, and the skew has evolved quite a bit in BITO since it first launched. Initially, a lot of our listeners were big fans of it because you could do collars out there for very reasonable levels. You could buy the underlying, buy a fairly tight put, and then turn around and sell a decently out-of-the-money call and probably collect a credit. At the very least, you could do it for even money because the calls wing was so bid up from a vol perspective. Now, we saw a little bit of a sell-off recently in crypto that gave the puts a little bit more juice. The skew right now is pretty much even. If you did that collar or risk reversal, you can do it for maybe a few cents credit in one direction or the other. So it's not quite the extravaganza it was earlier, but it's also an interesting one, and it does trade a lot. So if you are looking for options, pun intended, here in the U.S., BITO is kind of one of your only games in town. I will mention really quickly, we talked about it recently on our This Week in Futures options program. CME just launched micro Bitcoin and micro ETH options just exactly a week ago. So those have just launched. So those might be something you might be interested in as well. Those are off their Bitcoin and Ether reference rates out there. Again, as you mentioned earlier, they don't have a lot of the other issues you see in the crypto world, which is collateral issues, counterparty issues. It's all centrally cleared over there at CME. So if you want to trade crypto with a name you know is going to be around for a while in CME, then that might be a good option for you as well. And there is also Ledger X, which is now FTX US derivatives, easy for me to say. And they are also an outlet for approved legal crypto options trading here in the US. Those are pretty much your three choices. You got BITO, you've got the CME options, and you have Ledger X. So until Deribit gets approved or is somehow allowed for US traders, those are pretty much where you're going to have to trade. But good question there, Mr. Crypto. All right, we're coming up against it. Let's see if we can squeeze these people in too, Brian. Let's go first to Anil VLC. He says, if you want to carry a position into the next month and the option is in the money, do you roll it or do you sell and buy? So I guess he's saying, do you leg it instead, Brian? What is your preference?
Yeah, I always prefer to roll. And it's mainly because, first of all, you're giving the market maker, whomever might be trading with that position, you're giving them a buy and you're giving them a sell. You're giving them, ultimately, if it's a market maker, you're giving them a hedge. And whenever you combine trades, it makes them easier for them to quote it. They're usually willing to give you a little bit more. Well, hesitant to say better, Phil, but I feel that way, at least. It's never a guarantee. So I'm always looking to roll. Very rarely, if it was an in-the-money option contract and I wanted to roll out further in time, would I just sell it and then buy it later. The risk of the marketplace is very concerning in that scenario, not to mention you usually are going to see better fills when you come to the marketplace with a package. So I have a tendency to get better fills on butterflies than I do on long call spreads. We're adding, every time you add a leg, it's a little bit easier to fill closer to the midpoint. Just keep that in mind.
Yeah, there's never a reason to leg it if you don't have to. If you know you already want to reestablish the trade, then yeah, just put it on as a roll. Much easier, much more commission friendly. Everything else we like about the world of options. Let's go really quickly. One more here. Let's go to Maximum. I like that handle. Maximum says, what would Brian say are his top 3 most profitable plays from the playbook, and what's the best time to use them? Well, interesting, Brian. I know you have a few go-tos that you like all the time there in the playbook. You kind of just talked about, our listeners just talked about one, the skip strike fly. I know it's up there, but if you had to pick your top 3 for Maximum, what would you say, sir?
Well, first of all, I would say that's what the podcast is all about. If I'm picking a strategy, I'm not necessarily saying this is the way that I would trade my own portfolio or I don't know. We have 40 different plays inside the options playbook. We can't just come in every single week and only look at a long call spread, if that makes sense. So we're always trying to look for scenarios where, okay, this is a little bit more expensive stock. They're announcing earnings. They're announcing on a Thursday, and I'm thinking of stocks like Amazon, who usually always announces on a Thursday. How might I use this strategy for Amazon as opposed to this strategy for Walmart that's announcing earnings? And so that's what Options Playbook Radio is all about, is the timing of when to use these trades. Now, a lot of them, when you're talking about FANG stocks and more expensive stocks, which are usually top of mind, I'm going to talk a lot about butterflies. It could be a skip strike, could be a regular butterfly. Though that is probably the trade that's the most talked about, and it has a lot to do with the underlyings that we're discussing, because most people like to talk about, well, everybody knows the FANGs: Apple, Facebook, Amazon, Netflix, Google, which is now Alphabet. So a lot of those higher price stocks, which are now looking to split, make it feasible to talk a lot about butterflies, long call spreads. So those are some of the trades and some of the plays that we talk about the most often. My favorite personal trade, and I liked it so much that we actually coined it inside the options playbook, is the fig leaf, where you have an expensive underlying. You'd like to be able to trade it. You'd like to manage your risk by doing that. So we buy a deep in the money option as a surrogate for the stock, and then eventually sell a shorter term call against it to try to bring in some premium to pay for some of the time premium of buying longer term options. That's my personal favorite, but I don't feel like I talk about it a ton inside Options Playbook Radio, because you just can't talk about it every week. It's not the most exciting strategy to talk about. So you basically summed up why we do Options Playbook Radio. So that I think that's a solid place to end right there, Mark.
Yeah, I was definitely going to guess a fig leaf, and I was going to say skip strike. I'm hard pressed for the third, Brian. Maybe some kind of some vertical or something along those lines. But definitely,
a long call spread.
Yeah.
I like to combine the two. Like I'll do a long call spread, center it around where the underlying stock is at, and if it moves against me, then I'll roll it into a butterfly. That's probably my favorite trade to do on a speculative basis. If I'm doing it on a short-term move, just do a long call spread to be bullish, and if I'm wrong and it goes down, roll it into a butterfly.
There you go. Great questions, everybody. Hopefully you guys had fun. I could tell a lot of you in the live had fun. If you want more live fun, listeners, stay tuned. We'll be back with a double dose of Options Bootcamp. We really must love you folks. Double everything across the board this week here. Double Options Bootcamp coming up 3 p.m. Central, 4 p.m. Eastern. So mark your calendars. You had to change the schedule a little bit, Dan being a bit of the prima donna that he is. So we'll be back Education Wednesday. All you folks in Secret Club, you get both of those episodes right now live this week. So stay tuned for that. Listening on demand, you'll get those coming up later next week as well. Mr. Brian, if they want to join the party for future huddles or maybe in between huddles, they want to reach out to you, where should they go? What should they do?
Well, a great place is to just email me. It's a very simple email, theoptionsguy@invest.ally.com. Or you can always follow me on Twitter. My handle is very simple there, also at Brian Overby. And I want to say thanks for listening, Mark. Thanks for hosting. We'll be back same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.